everyone, warm welcome to all. Here are some pressing questions that have captivated investors' attention and fueled discussions within the investment landscape. As the Indian markets soar to new highs, investors find themselves contemplating critical decisions. Is it the opportune time to invest or a moment to exercise caution? Are there still undervalued opportunities one can spot in this rising market? Let us hear what Trust Line's fund manager and chief investment officer has to say on these interesting and critical questions. Let me start with the first question. With markets near all-time high, is it not risky to invest now?
So not an easy question. I can understand where this is coming from. In my own interactions with clients and prospects, I'm being asked this question very often. With markets trading near all-time highs, is it not risky to put fresh money into the markets, especially when there is growing noise on recession, inflationary and interest rate challenges globally? So will it not be wise and prudent for investors to wait for the dust to settle or wait for the deeper correction in Indian markets? Fair question. There are no easy answers. Investors have to keep a couple of factors in mind while dealing with this question. One, though Indian markets are very close to all-time highs, one must remember that it has been trading in this range for the last 1.5 years. Last time when it hit the lifetime high was in fag end of 2021. So markets have spent quite a lot of time spending time in this range for a very, very long time. When markets break out of that range after spending so much time, it would signal a huge technical strength, which means a lot more to come if the market breaks out. That is one point investors have to keep in mind. Second, we have two contrasting scenarios on hand. On one hand, with a weakening global macro, with a higher interest rate environment, and limited visibility in terms of what Fed is likely to do, when it is going to finish the tightening cycle, if at all, and if there's going to be any rate cuts, when is it likely to be? So there are a lot of uncertainties globally. That's one side of the picture. Second, if you look at India, India macro is getting stronger by the day. India's macro already was standing out for its rising reserves, resilient rupee, and attractive growth cycle and superior external debt profile. That was already the case. Now, with the new data point and current account deficit, which is rapidly declining, this macro is getting stronger, much more stronger when you get the new, when you are getting into the new year. So the data point which I'm referring to is the latest one on current, when trade account deficit, which has come for April. If you look at the data point, I think for the first time for the last 2-3 months, I think we have been hitting near break-even in trade deficit when you include service. This is thanks to huge surge in service exports. And, when the number came in February for services, people thought it could be a blip. But you had the March number, now April number, the growth numbers above 20-25% for service exports. Looks like it is sustaining. Add to this, the expected gradual shift in FI reallocation from China to India over time. With all these, I think India's macro looks really strong as the days goes by. Now, with this kind of strength, does it mean the markets are going to lap up the story and then get into a runaway momentum? Very unlikely, because financial markets are a different beast. They gain momentum when flows gain momentum. So given the expectation that Fed rates or the US interest rate is likely to be elevated longer time than one is expecting, it is very unlikely that the flows will gain momentum anytime soon. Though, if you look at the Indian market starting April, I think there's been a kind of a turn for FI numbers. We have received more than $4 billion since the beginning of April. But one is not very sure whether this is a serious turn for the FI momentum or is it, kind of a blip. We really don't know. We will know only in hindsight. But at this point of time, it looks like FI flows, will it really sustain? That's a big question mark. So in this kind of setting, I think markets will continue to reward stock-specific actions like what it has done in the last 1.5 years since October 2021. and it's unlikely to change. That's our view. And so the investors can choose to navigate this period through a phased deployment and bottom-up stock-specific kind of approach. Now, in summary, what we're saying is, use ride this volatility using a phased approach and stock-specific opportunities, and get your portfolio ready for the big turn, as and when it happens, when there's going to be a big shift in terms of FI flows or a big shift in terms of FI momentum. So the short answer to the question is, instead of trying to time the entry, investors should look at kind of a gradual and phased deployment, given the huge and strong sweet spot where India's macro is, and given the huge visibility and strong prospects for India's macro.
My next and final question: do you still find undervalued opportunities in this environment?
So this is a very interesting question. And with FI's numbers slowly turning in favor of India, broader markets have gained huge momentum starting from early April. Just to give a sense of the numbers in terms of what the indices have done since the beginning of April. Look at small cap index. BSE small cap index is up near 11% in this period, and BSE mid cap index is up by about 9.5%. And Sensex is up near 5%. So that's a huge, huge surge in a very, very short period. When markets gain momentum like this for a very, in a short period, of course, one needs to expect that the pipeline of ideas will dry up. That's natural. But in our phased deployment model, we don't see this as a challenge. Let me explain this. So look at our model portfolio in our PMS strategy, value strategy. We have about 24, 25 stocks in our model portfolio. Even now, when the market is trading near lifetime high, we still have about 30-35% of the stocks which are in our target price range, which we can deploy for the new money. And over a period of time, through our phased deployment model, using the volatility in market, we are very confident that we can deploy even 90% of the client money. So we don't see as a challenge in terms of deployment, because I can also give you examples. This has been the case for markets for the last 1.5 years. It has done nothing. It has been all over the place, but markets have been staying stuck in the same place in spite of huge movement across last 1.5 years, which means it has been in the trading range. In that kind of a setting, clients would come in the last 1 year. Clients would come in April or March or January 2022. Our returns, if you look at it, it is done well over 20%, vis-a-vis benchmark small cap index of BSE, which is done close to about 12-13%. So the short answer is there are still opportunities, and the only advice to investors is they should pursue a very gradual approach and deploy in a phased deployment manner with a stock-specific kind of an investment approach, given the very, very strong long to medium to long-term fundamentals of India's story. With this, we come to an end of our brief Q&A. Thanks for this Q&A opportunity. Hope our subscribers would find this very insightful and valuable. Thanks a lot.
For more videos, subscribe to our YouTube channel. Stay tuned for further updates and follow us on other social medias.